Atsi Sheth, the economist at Moody's, joins us now. Good morning, Atsi. Good to have you with us. Is the situation, setting up for a rating upgrade for India at all?
But our outlook on India's Baa3 rating is still stable. The report that you referred to that we did publish last week is talking about the growth conditions which we think are crystallizing towards an acceleration. And that is certainly true. But as we say in the note, it's not growth alone that will determine an upgrade, but really how institutional metrics improve, how fiscal metrics improve, how the infrastructure environment improves as well.
Okay, so should we assume that as of March 1st, if the fiscal deficit number has been bettered than what was budgeted last budget, if the target for the next budget is impressive, at least lower than the 4.1, would that be enough reason? What else would you watch out for?
Sure. You know, Lata, it's not a point-in-time estimate of any of these metrics, be it fiscal or inflation, but really a longer-term outlook on where these metrics are set to go. That's what determines the rating and outlook. So you talked about the budget numbers in March, and certainly we expect the government to come fairly close to meeting its central government deficit of 4.1%. But what we're really looking at is the consolidated general government number, which is still around 7%. So if you add the central government plus the state government deficit, that's at around 7% currently. And what we're looking for is there visibility that will take that 7% number closer to the 3 or 4% that we see in other countries rated at the BAA level. So that is something that we'd be looking at, not just the last year's or this year's budget deficit number. Similarly for any of the other metrics that you could point to, like inflation and growth.
Atsi, hi, morning. So what are the government measures, if implemented, that could enhance the sovereign profile of India?
Certainly, and some of these, Sonia, have already been announced at least, and we see them being implemented. And there's two aspects to this. There are some measures that have been announced by the RBI and will be implemented by it, and then there are some measures that are announced by the central government. There's also a third set of measures that could be announced by the state governments and implemented there. We think each of these measures will be incremental. For instance, there's the Jan-Dhan that's announced by the central government. That will help the savings profile of India. There's the Make in India, which is a broad sort of term to describe numerous policies, be they related to infrastructure, be they related to labor reforms, etc. We think all of these together, although they're incremental, will somehow lead to a crystallization of growth that's sustainable over the long term. On the RBI side, there's banking sector reforms, which we think are very important. As we've talked about on your show before, the banking system, both the asset quality and the capitalization levels, are constraints on the sovereign rating because they really point to the sustainability of the financial sector, particularly its role in supporting growth in the future. So we think those areas of reform are also important. So that's a very broad range of measures, but we think all of them will add up to supporting the sovereign profile. However, it will take time before these measures are actually implemented and then reflected in the metrics that we're looking at.
So really, what kind of a time period are you looking at? Just a budget announcement on February 28th is not going to suffice. Are we looking at a potential rating upgrade if the metrics fall in place 6 months ahead, 1 year ahead?
Our rating outlook is an organic thing. It's dynamic. So we actually look at how things are evolving all the time. And here are the three things that we'd be looking at. You talked about the budget. So what we'd be looking at is, are measures in place today? And they are not as of now, but are there expenditure measures in place that could take the general government deficit from the 7% level lower down to the 5, 6, and then towards the 4% level over the next 3 or 4 years? That's one. Second, are conditions in place for inflation, which, the last numbers show 6.5 for CPI, 2.5 odd for WPI, but are the pressures or the constraints on inflation that have led to recurrent pressures from time to time? Inflation goes down and then it goes up again in India. So what sort of framework is in place, both on the monetary side, but also on the supply side, that could keep inflationary pressures from recurring over the next 3 to 4 years. And then the third aspect is how strong is the banking system? Will it be playing a supportive role as growth accelerates as we expect it to? Or will it be a constraint on growth either because of inadequate capitalization or continued asset quality problems? Those are really the three broad things that we'd be looking at.
Now, it's widely expected that inflation is going to be sub 5, maybe even sub 5 in November, certainly sub 6, perhaps even in December. Will that suffice?
I would say no, and here's why. In India, given the demographics of the country and given the food supply-demand issues, it's not just current inflation, but what happens when you have a drought, which happens from time to time, or any weather-related changes in India. What happens is that inflation spikes quite dramatically at that time. There need to be measures in place to address this sort of vulnerability to drought from time to time, be it better irrigation, be it better management of stocks, things like that. And that's what we'll be looking at on the supply side with regard to food inflation, which is a big driver of inflation. One of the aspects of the inflation sort of subsiding in recent months, at least, is commodity prices. And that, of course, is linked to the growth outlook, the global growth outlook, of course. And, so we recognize that while inflation is coming down, some of the factors that lead to it coming down may be temporary. So it would depend on our view on commodity prices in the future. And then there's a third element that drives inflation up, particularly if growth accelerates, whether infrastructure and regulation keeps pace and allows investment to expand such that you don't have inflationary pressures building up where demand builds up, but supply is not keeping pace with that demand. So that's the other aspect. So it's not just that, whether it's 5% for a couple of months or whether it'll stay 5% for 4 or 5 months, but whether the factors that lead to higher inflation at different points in time for different reasons, those factors are addressed or not.
Okay. Just one follow-up to a point that you made. How much does the recent fall in crude bring the fiscal deficit target within reach, and how much of a positive factor would that be?
Oh, Sonia, the fall in crude is really very supportive for India in a couple of ways. One, as you said, the fiscal deficit target, of course, now is better within reach than it was if this hadn't been the case. The second is, in terms of policy, the deregulation of diesel, which we wrote about and we said it was credit positive for the sovereign. The fall in crude allowed this deregulation to happen without an inflationary impact. So it allowed a politically difficult policy measure to be taken, and that is positive as well. And then, of course, the input prices for manufacturing and infrastructure coming off because of lower commodity prices set the stage for higher growth in India. And that higher growth will eventually lead to higher revenues. We're not seeing that as the latest budget numbers show. We're not seeing those higher revenues yet, but we think that will also help the budget over the medium term. So, in 3 ways, very supportive.
Actually, I'm being warned on time, so very quickly, what's Moody's view on crude in 2015?
Well, we think that, current levels, there is not a chance of a spike for sure. How further down it goes will depend on the growth outlook. I think by now, prices have really discounted the fact that growth is likely to be subdued in 2015. There's also demand and supply factors playing up here as well with the supply coming on stream. So we think that current levels will probably sustain.
So basically, what you're saying is there won't be any ratings upgrade. You'll wait for the budget and then you'll take a call, right?
We'll wait for the budget and how the measures that have been recently announced, whether it's Make in India or the RBI's banking sector reforms, how they're implemented to revisit our view on institutional strength and the constraints on India's fiscal profile.